Hi, my name is Joshua Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 5th of August, and it comes off the back of a massive week in terms of volatility. Of course, we saw 4 of the Mag 7 reporting their earnings. We also saw a huge amount of economic data being released and central bank announcements coming online as well. But crucially, we ended the week with the US jobs report, where we saw a significant deterioration in terms of payrolls. We saw a move towards the upside in terms of unemployment, but thankfully it was saved somewhat by a move towards the downside in terms of the average hourly earnings figure. That leads us into a week that certainly doesn't compare in terms of the sheer number of major events that we've got to look out for. But nonetheless, it should still be an interesting one as we see everything that's come before this still feeding into this new week. And then we're looking out for some very specific data points to be able to drive markets going forward. Let's first of all take a look at the key events as highlighted within trading economics as their sort of tier 1 events of the week. You can see on Monday, kicking off with the ISM Services PMI over in the US, we're expecting to see a rally up to that 51 mark. That's certainly going to be a really interesting report coming off the back of the decline that we saw for the manufacturing ISM reading on Thursday just gone. Tuesday, we get the RBA interest rate decision expected to keep rates steady. We've got balance of trade coming from Canada and Germany, the IV PMI on Wednesday coming from Canada. Again, more trade data coming out of China on Thursday, and Friday wrapping things up with the Chinese inflation rate and the jobs report coming out of Canada. The first area I wanted to talk to you guys about is Australia, and Australia comes out with the latest interest rate decision from the RBA on, I would say, Tuesday morning. It depends where you are in the world. But essentially what we're looking at here is a hold, right? 4.35 expected. And it's notable that if you think about what the rates are elsewhere and you compare to where we are here in terms of the RBA, there's a difference. And that difference really does play a role in changing the expectations for the RBA in relation to some of the other central banks out there. And I'll highlight exactly why. You can see here in terms of inflation in Australia is more of an issue than we've got for many of these other regions, where they're managing at least to get below that 3% mark. And that points in the direction of a return back down towards target in the not too distant future. Well, Australia 3.76, certainly struggling to drive down inflation. So the RBA, by and large, for much of this year, we've been looking towards 2024 as a year that will see nothing in terms of rate cuts. And in actual fact, we had seen a period of time where people had started to point towards a possibility of another hike from the RBA. And again, that highlights the differential between where the RBA are in terms of rates and where some of the other central banks are. So inflation remains elevated for the RBA. And we can see here part of the reason why we don't necessarily have the same kind of emphasis on rate cuts for the RBA is given what's happening in terms of inflation, but also relative interest rates. You can see here with the blue line, somewhere in the middle of it, it's above the ECB and certainly well above the SMB or the Swiss bank. But you can see it's significantly below some of the other central banks and notably below their neighbors at the RBNZ at 5.5. And you can see significantly below that for the RBA. So they've already sort of kept rates relatively low compared to some of the other central banks. And I remember commentary in the past coming from the SMB where they essentially said, let's leave the FOMC to do the heavy lifting on this. Their actions should help in terms of disinflation, and it's not necessarily up to us to put the pressure on in the same way for Australian consumers. Now, here's the expectation or the outlook for the RBA's interest rate decision. As you can see here, just a 7% chance of a cut attributed according to the Icon platform. And then looking beyond that, what is going to be the timing for that first rate cut? Well, markets looking currently for December as the most likely time for a rate cut, with a 75% chance of a rate cut. But we've also got essentially a coin toss in November. So there is an expectation that we will see one cut before year end, and therefore some of the movement around this meeting will likely come given the shifting expectations around this year. We don't necessarily think we're going to see a move in terms of rates this time around, but I think it's likely that we will see interest rates cut before year end, and therefore it's a question mark of how do those expectations shift. Now, in terms of the likes of the Australian dollar against the New Zealand dollar, so let me just stretch this out into full screen mode. And so the Australian dollar against the New Zealand dollar, I think, is always a very interesting one. You can see here this deterioration that we've been seeing of late. This is the weekly time frame, really reversing the gains that took shape over around about a month and a half through June and much of July. But we've seen a big pullback over the course of the week just gone. The thing is that markets are expecting to see the RBNZ cut rates in August. And we're looking for a single rate cut from the likes of the RBA by year end. So there is a case to be had here that we might see some strength for the Australian dollar and some weakness for the likes of the Kiwi dollar. So we've seen this pullback at the moment, but as you can see here on the daily time frame, the trend is very much a bullish one. So this pullback looks like a potential buying opportunity if we see the right things, right? So let's just look here in terms of sort of retracements. You can see here that we're around about 50% retracement at the moment, so just below that threshold. So we're coming into the deeper areas here. So this is the kind of area where we might see a rally. And as you might follow, I prefer deeper retracements, but I also like to see a deep retracement and then an intraday bullish reversal signal that you can then shape a trade around. In terms of the hourly time frame, we've got a very clear-cut trend playing out here. We've got this pullback, consolidation, pullback, retracement here, and looking to potentially sell off once again. So there is a good chance that we do see further downside over the near term. Let me just tag this on. So we've come into a 50% once again. We're starting to see some downside. Essentially, it's just a case of like, if we break back towards the downside, we break this 1.0915 support level, then that would mean that the sort of key level that we're looking out for would shift down to this 1095. Until that low is taken out, then it's this 1.1 threshold that needs to break for the bulls to come back into play. But so I'm just following this intraday trend, and when that intraday downtrend ends, that's when you can zoom back out and say, okay, fine, where are we now, and how can we shape a trade around that for a potential bullish resurgence coming into play here? But ultimately, a lot of this comes down to how the likes of the RBA shape things in terms of expectations going forward. And as things stand, people expect to see a rate cut from the RBNZ, and we don't expect to see anything from the likes of the RBA until year end. And that should provide the basis for a potential resurgence coming into play once again for the likes of the Australian dollar against the New Zealand dollar that has, of course, over the course of the past week, reversed a significant amount of the gains seen throughout June coming into July. Next up, I wanted to bring the outlook here for the US. Now, of course, the week just gone has been a busy one for the US. We've seen the FOMC meeting, which essentially outlined that the Fed will cut rates in September. And they moved away from that single mandate and back to the dual mandate. It means that they're pointing towards the need to control the deterioration in the jobs market alongside the need to control inflation. This highlights the fact that they're feeling more confident around that sort of controlling inflation piece, and they're willing to look beyond that. Now, crucially, that's come at the time that we've seen a deterioration in terms of the jobs market. So that points towards the potential for significant action from the Federal Reserve. Now, one thing that's really notable in the week that's just gone is that we saw the ISM Manufacturing PMI with a collapse in that figure, pointing towards a possibility that we're seeing the jobs market really reversing. That was followed up by the jobs report itself. But what's key here is that we're kicking off the week with that ISM Services PMI reading. And as you can see here, I've left on all of the different metrics, the underlying metrics. This will be key. And so I would implore you, if you're following this, get onto trading economics. Not all of the economic calendars provide this level of granularity. And certainly if you're using Forex Factory, which I also use because I think it's just a good sort of top-down, no-nonsense approach, that won't provide this level of detail. And what you need to see when you see this report is all of the different underlying metrics. So for instance, are we going to see weakness in terms of, say, new orders and employment and business activity, but strength in terms of prices? That's exactly what we saw in terms of the manufacturing sector. And if you see that, you see deterioration in terms of the economic outlook, but upside in terms of prices, which means that the Federal Reserve might be held back in terms of their ability to act. Now, fortunately, that was followed up by the jobs report, which saw deterioration on the economic side of things, which was higher unemployment, weaker payrolls, but it came alongside the deterioration in terms of the average hourly earnings. So that meant that the Federal Reserve were able to act. And so it points towards further easing ahead. But certainly that's going to be the mainstay. I would also point towards Thursday's initial and continuing jobless claims. We saw a spike in both of them. The continuing jobless claims in particular has just continued to climb. And so that is another jobs metric, employment metric that really has been highlighting the weakness within the jobs market as things stand. So a few different things to show you. First and foremost, here's the breakdown for that ISM manufacturing report that we just saw on the Thursday just gone. And as we can see here, the weakness has taken hold with the overall figure, which was 46.8 at the top, down from 48.5. So a 1.7 decline there. And that was fed in by weakness in terms of new orders, weakness on production, weakness on employment in particular. Look at that, 49.3 down to 43.4. Big collapse in the employment side of things in terms of US manufacturing. What didn't decline? Prices. Prices up to 52.9, increasing at a faster pace. You know, it's a worst case scenario, quite frankly, from the Fed, because if they're talking about the idea that they want to control inflation, they're not doing it here. If they're talking about the need to keep the jobs market on an even keel, they're not doing that here either. So really, it was a worst case scenario for the Fed, and it pointed towards, and it led to significant weakness across US equities. In terms of the outlook for the services report, this is the report from last month. So this shows you the trend, but also shows you where those numbers stand in terms of the services side of things. We can see it dropped back down to 48.8 from 53.8. So we saw a big decline into contraction at last month's report. So as you can see here, this is going to be a really, really important report. If we see a rebound back up into expansion, which is what markets are predicting, remember we've got it here. So markets predicting a rally up to 51. Then, maybe people are going to have some of their concerns allayed. But in particular, if you're looking at this employment side of things, you can see here 46.1 down from 47.1. And manufacturing, you've got 43.4 now. So we've got real weakness, real contraction on both employment gauges, on both manufacturing and services. So keep a close eye out for the employment side of things. And that should really give you an idea of what the Federal Reserve are thinking, given that they're now back onto a dual mandate. Prices, we did see it slow down, but 56.3 is still very elevated. You can see it's the highest figure beyond that inventory sentiment figure at the bottom. So a real high pace of growth in terms of prices within the services sector. 85 months we've seen here of increase in prices. We need to see that come down. And so if you're looking out for this report, you need to see that prices element. You need to see that employment element. Those are the two that I would follow beyond that headline number. But it's going to be really key as we go forward. Here's the outlook for US jobs now that we've seen the latest jobs report. Upside in terms of unemployment, and that jumped from 4.1, and that slump in terms of payrolls, it came off the back of a big downward revision last month that we saw for April and May. So we've seen big downward revision to prior numbers, and now we're seeing another big decline in terms of payrolls down to 113K. So lower payrolls, higher unemployment, only really rescued by that decline in terms of average hourly earnings, which does continue to move lower, and that at least facilitates a potential dovish outlook for the Federal Reserve. And that is highlighted here. Look at the shifts that we've seen in terms of expectations. According to the CME, this is the CME FedWatch tool. Look at the shift in terms of expectations for rates by year end. So this is for the December meeting. On the far right, we've got 5.525 to 550. That's where we are at the moment. And the expectation at the moment, the base case scenario, is 425 to 450. That means markets are now pricing as a base case scenario 4 rate cuts are essentially 100 basis points worth of cuts over the course of 3 meetings. And that means one of these meetings will bring a 50 basis point cut, and markets are pricing that in for September because of the deterioration we're seeing in terms of the jobs market. We've also got an outlier, but still a very strong possibility, over 40%, that we see 125 or 150 in terms of cuts for the next 3 meetings. That would be massive easing and real dramatic actions taken off the back of this weakness that we've seen, in particular around the jobs market, but also that ISM manufacturing reading. So the key thing here is, if we see the same thing for the ISM Services report as we did with the ISM Manufacturing report, i.e. weakness on the economic side of things, and then strength in terms of the prices, but I would say actually if we saw weakness in terms of the prices as well, that would provide the basis for greater expectations of rate cuts going forward. But quite frankly, it always appears to be the case that markets swing from one direction to the other in terms of unrealistic outcomes when it comes to the Federal Reserve. I think it's unrealistic that we're going to get 150 basis points worth of cuts over 3 meetings, or 125. But you never know. You never know. I mean, they took drastic action on the way up, right, to try and combat inflation. Will they do the same on the way back down because of the weakness we're seeing within jobs market? Well, in terms of markets to follow here, I wanted to bring up the Nasdaq. It's been having a bit of a tough time recently, to say the least. Tech earnings have, I wouldn't say been overcome, but now that we've seen the likes of, I would say, I think we've seen 6. Yeah, so we've seen 6 of the Magnificent 7 all report now, just waiting for Nvidia, which usually comes right at the tail end of earnings season. We've seen many of these hurdles overcome, and we've done so in relatively good fashion, I would say. You're looking at a market that certainly has been in retracement mode, partly driven by fears, and you're seeing this pullback coming into this 76.4 fib and this ascending trend line. You see markets all of a sudden thinking we're going to see a huge amount of easing from the Federal Reserve. And so I don't think that we're going to see this big collapse. Now, the question mark here is, are we seeing the beginning of something that's leading to a US recession? If that's happening, then it's really down to markets as to whether they care more about the economic side of things, or whether they care more about the monetary policy side of things, right? In the past, it's been like bad news is good news, because all of a sudden the Fed's going to cut rates loads. Well, we're in that position, right? Markets now pricing 100 to 125 basis points worth of cuts over the coming 3 meetings. So is that a good thing or a bad thing? It's down to markets for them to ascertain that. But we have pulled into this deep fib zone and that ascending trend line. There's a possibility that the bulls come back into play. And I'd certainly say we'd feel more confidence with that if we rally back up to this 19538. But in terms of earnings for those big tech names, they've done relatively well. I wouldn't necessarily say that the fears that many had coming into this earnings season have been realized in terms of a big slowdown. And therefore, we do have the possibility that we bottom out around this area with the confluence of Fibonacci and trendline support coming into play. Certainly a rally up through that resistance level will give us a double bottom formation and point towards a resumption for the bulls. But certainly a very interesting time at the moment with the repricing around the Federal Reserve. And that's going to continue, even though we don't have a huge amount of data. As many people would look at it and say, well, we don't have, the likes of inflation, or we don't have the likes of the payrolls coming out. Well, that ISM Services PMI figure is going to be a really key one to be watching out for. And finally, I wanted to touch on what's happening in Canada. We have a host of data points coming out over the course of the week, but it really culminates with Friday's jobs report in particular. Now, the reason for that is that Canadian jobs have been in the limelight with the fact that unemployment has been rising to a greater extent than you're seeing for many of the other countries out there in the developed world. Now, if I show you the unemployment rate here, you can see that Canadian unemployment, which is the orange line, is rising at a much faster pace than you're seeing elsewhere. I would say New Zealand is also rising at a relatively faster pace, or fast pace, but it is some way away from where we are in terms of Canada. You can see Canadian inflation now up over that 6% mark. So markets are expecting unemployment to remain at 6.4%. But that does provide the basis for a surprise. If we did see Canadian unemployment rise once again, that could point towards a third consecutive rate cut from the Bank of Canada. We've seen 2 in a row now. What are we going to see next time around? Well, this jobs report will do a lot in terms of informing us as to whether the Canadian economy is in distress and the jobs market's in distress, and that they need to act once again. In terms of market expectations, will we see a rate cut? Well, markets are expecting a rate cut. Not only a rate cut, they're actually pricing a potential 8% chance of a 50 basis point cut. So markets pricing in lower rates at pretty much every meeting going on from here. You can see here, expected to drop down to 3.75 by year end. So they're expecting 3 rate cuts in 3 meetings, and this jobs report should further inform us in terms of those expectations. To round things up, I wanted to bring up the Canadian dollar against the Japanese yen. Now, the Japanese yen has been absolutely steamrolling pretty much everything within the FX markets at the moment, and this hasn't always been the case. It has generally been one of the biggest underperformers out there. The question mark here is, will it continue apace? Well, we're looking at the potential for the Canadian central bank to continue to cut rates going forward. And we're looking at the, to hike rates. And we're looking at the Bank of Canada the Bank of Japan to hike rates, the Bank of Canada to cut rates. And so we're looking at the possibility of further downside as long as that continues to play out and those expectations continue. The fear here is actually, if you're looking for this yen reversal, there's a possibility that maybe the Bank of Japan could suddenly get a little bit scared, because the declines that we're seeing in terms of the Nikkei 225 with 5.8% decline to wrap up the week it's likely to raise concerns. If we see some sort of pushback, or maybe the Bank of Japan suddenly starts saying, actually, we're not going to hike rates again for the rest of the year, then it points towards the possibility of this current sell-off reversing. But as things stand, we're selling off and crucially coming into this 104.19 support level, which tallies up with this long-term ascending trend line. Could that be the bottom that we rebound from? Perhaps, but it could also mark the beginning of a wider pullback coming into play here. Let's move in terms of the short term. You can see pretty much over the course of the past 3 weeks, it's been selling off every single day. So very reliable trend, and the trend is your friend until you get to the end. And we haven't seen that end come into play quite yet. A rally up through 107.97, 109.2. Those are the kind of levels that we need to see broken for this trend to be out of play. But until that happens, the bears still remain in charge here, and I wouldn't be surprised to see further downside, especially if we see weakness in terms of the Canadian jobs report, with that unemployment rate continuing to creep higher at a much faster pace than we're seeing for many of the other countries out there in the Western world.